there is one company that doesn't need any introduction, it's our knowledge partner, McKinsey. We invited McKinsey, Simon Kaesler and Christian Irlbeck to share their vision on the future of insurance, but also to take stock on the current state of the industry, of digital transformation, of next level innovation, of the state of insurtech, and what is required to make the next essential leap. Please buckle up. Next on stage, Simon Kaesler and Christian Irlbeck.
Good morning. Thank you. Yeah, indeed. We want to talk about our view on the insurtech landscape, and a lot has happened in the past couple of years. We still believe this is a very interesting and exciting space, and we believe actually this market is still irresistible. So when you look into the overall market, I mean, we are still talking about billions, even trillions of premiums, 3 trillion in non-life GWP alone, a growing market. We are also talking about significant profits that are still being made in the insurance industry, 400 billion. Also here we saw a big growth in the last couple of years. So this is highly attractive. Second, there's also a lot of opportunity from underinsurance. We will talk about that. A lot of areas lack insurance, and there's massive growth potential. And last but not least, I think interesting for this room is also there's still very, very limited disruption after a lot of years of insurtech. And we will talk about that as well. You see, for example, that the share of online insurance, digital insurance, is still only about 10% in retail, in other lines even lower. And this is even true globally. Europe is quite well ahead, but lots of room for growth in that dimension. When you look into the historic development of the insurance industry here in Europe, you see premium growth very nicely, no real hit in COVID. Also, I mean, the profits developed quite nicely and our outlook is also rather positive. So overall, I would say a stable, profitable industry, a good baseline and good basis to be in. However, there are some challenges that I'm sure you are aware of. There are the recent challenges from inflation, for example, Nat Cat this year in many of the countries that are harming profits. And we see, I mean, in different scenarios that we modeled here, that the insurance industry might see some declines in especially profits when we have a scenario what we call higher for longer. So inflation continuing, putting pressure on profitabilities especially. So there is some, I would say, short-term risk, but in the long run, there is still a very healthy profit pool. And also in absolute terms, this is a very healthy situation. When you look more into digital disruption, you see that the insurance industry is somewhere in the middle at the moment, as we measure it. We're measured here by pace of disruption, vulnerability to disruption. It's somewhere in the middle. There are, of course, other industries like travel or retail that have seen much more disruption in the past couple of years. Banking also. And we are somewhere here. We see also lots of investment now still into innovation, new technologies from the big incumbents, from insurtech, so that's still happening. We'll cover that in the next 20 minutes. And I think there is really along the entire value chain lots of potential. So we try to estimate the size of the potential in each of these cells along lines of business and the insurance value chain. And what you essentially see is that in all areas there's quite some potential from digital AI innovation. A lot, for example, in the retail space, but also in a lot of the other lines. And the value at stake that we see already today is quite significant, and much more will come. So that's a bit the baseline, and we will deep dive now into a few areas, starting with my colleague Christian and insurtechs.
Thank you, Simon, and also very happy to be back here on stage in Munich, and happy to shed a bit of light on how we see the insurtech space currently. So let's start with a few numbers first. Obviously, this curve is not surprising to any of you. We have seen, and we framed it overall also a roller coaster. We have seen a 10x increase basically from 2018 to 2021, where everything in the market peaked. In InsurTech, even more than in the global VC industry. And then it went clearly down with a lot of cost pressure on the companies, with funding market drying up, the economic challenges. You see the interest rate development here a bit, but also inflation pressuring the overall market. So what does it do with the players in the industry? What have people in the room have done? So we looked at a few players and picked 3 examples here and looked really, has their underlying economic performance changed and how has it changed? Yeah. So you see growth, you see the fundamentals, and you ultimately also see a bit how they improve on path to profitability. And if you take a deeper look, you see these InsurTechs, and this is true for the 3 we have here, but also for many others in the room and globally, growth is still there. Yeah? So despite drying out of the funding market, InsurTechs are still able to grow quite significantly. And we're not talking about here doubling from 10 to 20 million. This is in the hundreds of millions and billions space even, with CAGRs of like 30, 40, 50%. No insurance company would ever achieve these growth rates, so this is still quite remarkable. Number 2, you also see that the industry fundamentals are at least slightly improving. We can still discuss if like the high 80s are sustainable loss ratios, but still you see it's moving in the right direction, and players are taking a turn to move to profitability, which you can then also see in the overall net income. Yeah? They are not there yet, but they don't lose any more 80 cents on the dollar, so it's slowly but steadily getting there. So we'd also try to put what happens in the InsurTech space a bit in the broader perspective of the fintech landscape. So we basically took the publicly listed fintechs globally and sorted them by their net income margin. And what you do see is 3 things. Number 1, the vast majority of these companies is actually not profitable. Especially in the InsurTech space, these are the bars that we marked in blue here. None of them, of the public ones, is actually profitable. So this is the status point. Huh? Finally, you also see that there is strong polarization, and it's not impossible to reach profitability. Yeah? Some even having brilliant margins of 45%, but even in the other bars that you see here, there are more and more players reaching or already have reached profitability to drive value here. So we asked both the investors as well as the founders of what drives value. So let's start with the investors first. And there are 3 themes that basically stand out that ultimately drive value and also help on the path to profitability, which are customer ownership, sustainable improvements, and a real performance culture. So what do we mean by that? So customer ownership. Let's think about all the InsurTechs. We often see super high customer acquisition costs. Yeah? So, and this is not a problem if you are able to monetize the customers over 10 years and really own the customer. And if you increase a bit the prices, push on monetization, they don't leave directly, but you really create customer intimacy. Number 2, really 10x improvements. So this is not about taking a standard insurance product, putting it on a nice website with a flashy brand or anything, and then trying to sell it online with high customer acquisition costs at half a price. This is not a like really 10x improvements, but we really mean like tech-enabled, innovation-driven, really reinventing the space on the underwriting part, on the claims part, on new ways to reach the customers, and not just replicating what direct insurers have started 20 years ago. And finally, performance culture. So as I think many of you have experienced, the innovation game is a bit more a long run right now. So it really needs a team that wants to go the distance, that is committed to drive execution, as the ideas are, let's say, easier, but the execution is ultimately where the value is created. So we try to contrast this a bit with how founders are currently thinking about both opportunities as well as challenges. And we found 2 key themes on each side. So on the one hand, you do see that the opportunity is typically still in scaling the models. So it's not about now stopping growth and working on the cost side and then directly moving to profitability, but it's of course further scaling these models and bringing what you started in one of the markets actually to more markets. And we will see a bit of details on this on the following page. And secondly, of course, also moving more towards profitability, trying to work on monetization strategy in parallel. On the challenger side, of course, I mean, trying to achieve more with less money, being more cost efficient is not an easy game, so that is a clear challenge. And ultimately, the funding, of course, is also something where the mindset of many of the, not only the founders, but the entire company needs to adapt to, that this is now very different times from 2020, 2021. So let's take a brief look into what is happening on the internationalization side. And we asked 50 insurtechs, and probably some of you also in the room here today, based in the UK. So where do they typically go? And you clearly see, number one, actually more than half, so 52% of the insurtechs are actually trying to go international or have already moved into a market. And these typically more go through the Anglo-Saxon market. So from UK to US, to Australia, to Canada, given that the markets are somewhat more similar compared to continental Europe, bigger, same language, and easier to address from their perspective. Which is quite interesting if you compare it to many players that are more based in continental Europe, so France, Germany, Italy, who typically more move around these countries, and after they conquered continental Europe, then do the next steps. It's also interesting to note that barely anyone, or only a few ones, are really trying to attack Asia, despite being, of course, a large market both on the life and P&C side. And we rather see the B2B models that basically have a universal technology, let's say in claims, for example, to really expand really globally, trying to build a real global model across 10, 15, 20 markets, rather than the B2C attackers. And finally, and this was another outcome of the survey we did, and I think this is actually quite interesting, that it's not surprising that many companies have a growth or a customer metric. I think this is what everyone would have expected. But I think it's interesting to note that actually only 29% of the companies actually have a cost metric or a profit metric in their key KPIs that they actually look on a current basis and steer towards. So we see a slight shift towards, of course, unit economics and more profitability, but we would expect even further companies steering towards these metrics, while of course continuing on their growth journey. So this was a bit the overarching perspective on the insurtech space. So let's deep dive a bit into the European market and compare it against US.
Thank you, Christian. Indeed, when we double-click on Europe, we see about 850 insurtechs. Of course, it depends a bit on the way you count, but roughly this is the figure. Less than in Europe, in the US, but significantly more, for example, than we see in Asia and Pacific. We also see, I think, quite a geographical focus on UK, France, a bit more here in Germany. And a total valuation, if you sum it all up, of 40 billion, which is a sizable, larger insurance company if you would combine it. So not too bad at the moment. Still, when you compare it in terms of success rates, what you find is that Europe is lagging behind the US. So what we did here, we took essentially all companies that raised money from 2009 to 14, looked, I mean, how successful they have been in Europe and the US. And success means here there was either M&A, IPO, or Series C+. And this number is a bit lower in Europe. So US companies here are more successful in scaling. There are a couple of companies, and we will see that when we double-click here on a couple of insurtechs that are still a bit stuck in the middle, I would say. And the number that is out of business is comparable. This is also the case when you compare basically the funding funnels between Europe and US. You find that a lot of European companies don't fail more often than their US counterparts. but they don't advance so much from one stage to the other. So the advancement rate from A to B to C and so on is lower here in Europe. And this, I think, also explains why many insurtechs in Europe are still somewhat stuck in the middle. And what we did here, I think this is an interesting chart, so let me briefly explain. We looked into all insurtechs in Europe that were founded between 2015 and 19, and basically looked where they stand today. And we categorized them along these 5 blocks. So we have defined one category where we said these are real segment leaders. So in a lot of KPIs, leading high growth operations at scale. Then there are next-gen challengers, also nice growth dynamics, but still limited scale. A bit question marks in the middle, and a lot of stuck companies that are not growing anymore. And are struggling to scale, basically, with an unclear path to profitability. And as you know, I mean, at the moment, everyone is looking for profitability also. So if you don't have a plan to come to profit in the next 2-3 years, maybe it will be very difficult. And growth is important, but is not sufficient. And a lot of companies, so about half of the European insurtechs here that started between 15 and 19 are in that box, and 9% left the market. So this is not an unusual picture if you compare it to other industries where disruption happened. Of course, not everyone will be successful. There is a big number of companies that has been successful, but also a lot with the potential still. So the jury is still out, I would say, in a large number of these companies. What is successful in this space? I think we looked at it along these 3 clusters of business models. One is B2C, one is B2B2C, and one is B2B. And we have discussed here also in the past couple of years that especially the B2B models are getting lots of traction, which is also true still today. I mean, in B2C, the ones that are successful are the ones that can really differentiate, so that leverage data, find new ways to bring value to the customer, certainly not just by having a lower price and undifferentiated mass market disruption, as we called it here, which many have tried and failed, and you see a lot of these even listed with valuations down 90% or more. B2B2C is an interesting space. So also there, I think it's important that you go for enterprise scale partnerships, as we called it, and not like smaller pilots. There are lots of smaller pilots, a long tail here that is not moving the needle. And in the B2B space, I think a highly interesting space. A lot are focusing on this. What is important here is to have a very, very clear value proposition. And often this is very narrow. So it's not like saying we disrupt claims entirely. We do certain pieces maybe in that value chain. And those models we saw, at least in the last years, have been quite successful. When you look into B2C a bit more, one reason why it didn't really disrupt is also that the market for direct distribution, so people buying online or through call centers, has not really moved a lot in the last couple of years. So you see here the different shares of direct insurance, 18% in Europe, which is already quite leading compared to the other geographies. But this is also influenced a lot by UK, which has a much higher figure. In continental Europe, it's below. The reason is, I think customers are still not comfortable to buy online. They are very much linked with their agents, brokers, bank assurance. There are new models. Also during COVID, we didn't see an increase that many have expected. I mean, of course, one reason was price. Prices were down. People didn't switch so much. So this might change now a little bit. But still, I think there's no disruption in this space yet, other than what people expected. When you translate this into euros and you look into this entire B2C market in Europe, you find about 41 billion market size B2C. A lot of that is actually classic direct. So this is not insurtechs. And classic direct, I mean, are the companies that started already 10, 15, 20 years ago even. Like in Germany, we have this HUK, for example, that started very early with direct distribution, is now one of the market leaders here. And that is the vast majority of this B2C distribution. We tried to estimate also the size of insurtechs, and you see here it's about 10% of that B2C part. And if you think, I mean, that B2C overall is between 10 and 20%, and 10% of that is insurtechs, you see basically that insurtech is at the moment only having a small single-digit share of the market. And we broke it down here by underwriters, MGAs. I think an interesting space is this last bucket, embedded insurance. A couple of players have started to focus on that. We see a lot of momentum here with non-financial companies that are now entering insurance. I mean, you all have heard from Tesla, with Tesla Insurance, and Elon Musk saying that this should be 30% of Tesla's value at some point just from insurance. But also other companies are entering that space. Booking.com has recently launched insurance. We see Amazon going into it. Apple has already a successful insurance product with Apple Care. So a lot of these companies are going more and more into insurance, and that goes beyond distribution. A lot of them want to have more of the value chain, want to do pricing, leverage their data, do claims on their own. And that, I think, opens up also lots of partnership opportunities. And we estimate here also quite high growth, higher growth than in the underlying P&C market. So that's where we are, and Christian will look a bit ahead.
Yes, so let's take an outlook here. Yeah, so we can discuss now, is the glass half empty, half full? I think we would all agree it's not entirely empty, it's not entirely full. We would still see a positive way forward due to several reasons. So let's take a view briefly at the industry. So I think we would all agree that ultimately there are still fundamental challenges that pressure the insurance industry, that also pressure the incumbents. Let's think for a moment of all the things that happen on the tech side. There is basically lots of opportunity, of course, but let's say rather slowish adoption. There's a lot of legacy systems. On the customer side, there are still, in many markets, actually low or even negative NPS, so clear customer opportunity to be captured. There is still underinsurance, what Simon also mentioned before, and a lot of opportunities we still see in this space. And insurtechs and scale-up startups are actually in a good position to capture some of this space. Of course, also incumbents will further grow and capture value, but we do see a coexisting ship. So let's think about what are the key driving forces of the insurtech, and we would see, number one, clearly the strong talent. Yeah? So the attraction of talent is remarkable. Even in the more difficult market conditions right now, we still see very good talent going into the space. Number two, there is basically a clean sheet, so there is not the tech debt that some of the larger incumbents have, where transformations, the roadmaps are currently running till 2035 or so, and they have just higher speed to capture these opportunities. And this might be not a game for like the mass market, the core motor insurance, but more for specialized niches, which still in insurance can be quite sizable actually. So let's take a deeper look. Yeah? So we plotted here a bit how insurtechs have also evolved and how their focus has shifted a bit. So when it started in, let's say, 2013 or 15, everyone was like, we disrupt insurance, we go direct, we do a bit of aggregator, which for many, let's say, has not worked out super well. So they shifted a bit more, reduced the direct spend, went from a more e-commerce model to being a bit more intermediate, going via the different aggregators, the price comparison websites, and started actually with physical distribution. And today, I think what we see, and there are a lot of successful players who do this quite nicely. Some even have like 80% or 60, 70% of physical distribution. So this is less the digital disruption in an e-commerce model. It's more the digital enablement of physical sales force, really focusing on core insurance competencies. Think of superior underwriting, claims management, better risk selection, which is, of course, difficult in the mass market, but very clear opportunity in all the different niches. Think of cyber, think of pet, and a lot of other markets. And they are slowly but steadily converging to the overall insurance channel mix. Number two, and we talked a bit about underinsurance and also niches. We estimated a bit what is actually the gap, the insurance gap from new risks, new products that could be filled over the next decade. And you do see that while the total market is roughly 600 million, 150 in motor, 450 in non-motor, especially on the non-motor side, there is a clear upside actually to address new risks. Think of risks evolving from the aging populations, all that happens on the cyberspace, but also additional liabilities like D&O and other products, and also climate change and natural catastrophes pose big risk to actually our ultimate customer of this industry and can help to build basically new models. And finally, you will not hear a McKinsey presentation these days without at least once mentioning Gen AI, of course. So technology is still a driver of change in this industry. And our colleagues from the McKinsey Global Institute estimated a bit the impact of Gen AI across the value chain, across industries, and come to basically the conclusion that there is potential across all functions of the business, especially, of course, in sales and admin. And that is basically around 70% on top of the impact of AI that was estimated before. But I think what's interesting to note is that you can see that these curves of like expectations, how fast things can be automated, are shifting quite nicely, irrespectively of whether you're in a more, let's say, ambitious scenario, trying to go for 30, 40, 50% over the next decade of automation of manual work, or the more base case scenario. You do see that Gen AI is expected to basically help on this transition to becoming more efficient. And we, of course, also took a view into the insurtech and insurance space, and there is rarely a day or a week where there is not a new headline of a company starting in AI, and I'm very sure you will hear about this topic much more over the next 2 days, also from many brilliant companies here in the room. And I think the ultimate question is this now a buzz of the moment or the tech of the century? I think there is a lot of like positive momentum in Gen AI, of course, but we also need to see currently this is all experimentation phase. Whether this is in the insurtech side or on the carrier side or on the service side, we don't see use cases at scale yet. So this is a clear opportunity to try to push this. Also, insurtechs are in a prime position, and we already spoke to a lot of the companies that are trying to push it, and we see a lot of momentum here. So with that, let us close, and we were very happy to be here today. We hope you enjoy with a lot of excitement that is already in the room over the next 2 days. And yeah, wish you a great conference.
Thank you.